What's up, guys? Your agent Tyler Wayrung here, and today this is going to be another real estate investment video talking about a particular investment that I made with the one and only Brandon Turner, aka Beardy Brandon. So if you guys haven't seen this video right over here, where I talk about my first investment in his fund, his Open Door Capital, the company he founded, I invested in their first fund. I put $50,000 in that, and I took the funds that came out of that fund actually closed, and I rolled them all into this next venture. But I got so many questions and comments around how that worked, what was all involved, and then what did I do with the money? So today I want to talk to you guys about exactly what I did. I took that money and rolled it right into the next deal that was on the line when I received that distribution from the Open Door Capital Fund number 1. And that investment that was available that they were raising money for was an A-class large apartment building in Austin, Texas. And I'll be honest, I don't know a ton of details about the deal. I did watch a couple webinars when they were actually raising money for that deal. But guys, I think I had let you know in the first video, I kind of trust Brandon and his team. And essentially, I kind of just am putting my money with him and trusting them to do the right thing. So that's one of the pros with this for other real estate investors who are more in the weeds and run the numbers and kind of make sure every little penny ties out. In this type of investment where you're a passive investor, you really have to make sure you trust who you're investing this money with, and you essentially hand it to them and let the rest go to work. All right. So today is going to be the first distribution update that we've gotten from Brandon and Open Door Capital since that we invested this money about 6 months ago. So the original reason I started being a passive investor is because I wanted to see what it was like so that eventually if I decide to raise funds, I know how to talk to people, how to keep them up to date. And so I want to let you guys know, I'm going to kind of let you guys see behind the curtains on how Open Door Capital and Brandon keeps me up to date on how my investment is doing. All right, so I'm going to jump right in here and just read you word for word the investment update that I got from Open Door Capital. I believe it was last week. This one was a $75K minimum investment around 6 months ago, and this is the first distribution, although they do send monthly updates, kind of just keeping us in the loop on how things are going. But this apartment complex is Heights on Katy, so let's dive in here. So, hey Tyler, happy Sunday. On Friday, I hit send on 1.4 million in Q2 distributions across our portfolio. It was a surreal moment for me. All right, he's talking a little bit more about his general stuff here. All right, and now here's an update on how Heights on Katy is performing. Again, that is the name. They did rebrand that apartment complex to Heights on Katy. All right, and let's get into the numbers here. Financial performance. Heights on Katy ended June at 90% occupancy with 16 move-ins, 17 move-outs, 10 renewals. June NOI, net operating income, came in at 28% below projections, while revenue missed our target by negative 11%, primarily due to lower than budgeted other income and fluctuations in physical and economic vacancy. All right, guys, so the one thing I'll just stop right here and say, I definitely appreciate just the transparency. There's been a lot of other people that I've watched videos about here. They always try to give you the rose-colored glasses or that everything's perfect, even when it's not. And I can tell you as an investor myself, I know things aren't always going to go right. So just tell me. Bad news never gets better with time. Hit me with the bad news right up front, just like he did here. So definitely appreciate that. And one thing, just call out, when you're investing as a passive investor, you're most likely, I'd say 99% of the time, you're going to invest into a value add deal, which means we're essentially, as a collective syndication, going to purchase this asset that's not performing great, or else they would have just sold it for retail. And we're going to do something to it. We're going to, do lots of things, add value to it so that 5-7 years down the road, we can exit and make a profit. So in the beginning, it's going to be turbulent. You're going to have things that smack you upside the face. And that sounds like what's happening here. So I'm not worried at all yet here. I'm going to just keep reading. However, as of this email, leasing activity has begun gaining occupancy in the low 90s, which is where, 100 plus multifamily, typically occupancy, you don't want it too high. That's a sign that you're not charging enough. Low 90s, low to mid 90s is pretty healthy. We do continue to dial in the cost of operations and total operating expenses coming in just a hair of our projections, mainly due to the 3-month pay period payroll expenses. He's getting a little in the weeds here. Long-term delinquency continues to be in line with this asset class with 23K across 6 tenants, which are currently being evicted. Yep. So that again, when you take over an asset that hasn't been performing great, you're likely going to have to kick some people out, deal with some of the associated cost with doing that. So, like I said, we're 6 months into this investment. In my mind, until we hit year 1 and 2, should we start to see this thing start to pick up. So, but again, I like the transparency. I like we're showing, look, these are our targets. Here's that we're under these projections. But let's talk about some of the property updates. 1 month out from being 100% complete with our exterior paint. And here's a lot of other stuff they did. These upgrades include granite quartz countertops, two-tone paint, updated backsplash, cabinet pools. We have contracted with our GC to complete a new dog park, pergola, fire pit, and barbecue. So again, this is an A-class property. They're doing this thing up to the nines, and that's what's going to give it the proper exit price at the end. So again, the reason why we waited 6 months to start getting these distributions is because they're putting a lot of capex, or that's the term they use in the multifamily world, but essentially they're doing a ton of renovation and value add up front to start to gain these tenants that will start paying higher rents. And if you're familiar with multifamily investments, the asset is valued based on a cap rate. So the higher NOI, which comes from the higher income, is going to give it that higher value at the end. So you have to kind of bring the property up, get that higher rents in across the board, and then that and subsequently raises the property value. So that's kind of what's going on here. All right, here's just kind of a little look ahead. Additionally, we're working on hastily, I like that word, on the following projects: new landscaping, upgrading exterior pool furniture, monument, etc., etc. Oh, package lockers, that's a hot one. Updating the activity center with additional games, pool table, TV, yada yada. So you guys can see here, look at these pictures. I mean, they're doing this kind of Pinteresty, just very updated. I feel like people would feel cool taking Instagram pics in a place like this. All right, now let's get to distributions. All right, your first distributions for Heights on Katy were processed on Friday. You should now be reflected in your InvestNext portal. I'm going to show you guys that here in just a second. We're excited to be paying out the full 3 months of accrued pref to Class A and hitting full target on our first month of Class B. All right, so quick highlight on Class A versus Class B. Actually, I think he might talk about that here in a second. Stand by. We continue to monitor the asset and market to ensure we have enough reserves in the property, but excited to be hitting projections right out of the gate. If you're wondering why did Class A hit accrued pref, whereas Class B hit monthly target, that was our plan. Just as a refresher, all right, yep, so here I think he's going to talk about the difference. Class A is the preferred equity share class, which earns a fixed rate of return right out of the gate, but doesn't participate in any profits upon the sale. Whereas the cash flows for Class B are projected to scale up to the full pref over the first few years as we implement our business plan. All right, guys, so essentially Class A, they get a fixed rate of return no matter what, but they don't get any upside. So they don't care if we resell this thing for 10 times what it costs. They're just worried about their fixed rate of return up front. So I'm a Class B investor. My big thing, I'm willing to take smaller distributions up front and more in for that longer exit 5 to 7 years down the road. So I want more of that upside, which you don't get as a Class A investor. Not going to sleep. All right, this allows us to strengthen our cash reserves given the number of large CapEx projects currently underway, especially in light of overall economic conditions. As always, any deficits on pref rollover to future quarters, and we always plan to pay out as much as possible without causing undue stress to the asset. Yep, so here's another thing. I get it. Everyone wants their financial return, but you also have to be willing to look at the bigger picture, and you don't want them to lose this asset or do anything that puts the management of this asset and their business plan at risk just by giving us a larger distribution up front. So most of the folks are looking for the down the road. So they want to stay heavy on cash reserves in order to make sure that their downside is protected as well. So definitely in line with the approach they're taking here. Our primary objective is always to keep the property defensively positioned given the large large and cash incentive projects underway. We never want to overextend ourselves to hit a certain level. Man, he just said exactly what I should have just read that. Please allow 35 days, yada, yada. Okay, hit your bank account. Yep. All right, so let's take a look at this. So here is the Open Door Capital Invest Next portal that he was talking about here. When you first log into here, they do talk about all their new openings. You can jump into any one of their openings. You can see all the executive summary, all the projections, things like that, images. I mean, they give you a little bit of everything. They record webinars on all their stuff too. And then over here, you see kind of their target rate of return, minimum investments, hold period, etc. here. So that's what you get if you want to jump into offerings. But for this example, I'm going to show you guys what you see in the investments tab. And this is a little skewed because it is showing both my investments from Fund 1 and my Heights on Katy investment here. So let's just focus on the Heights on Katy for the purposes of this video. So as you guys can see, back in November, I invested $75,000 and I got a whopping $188.85 on June. So roughly 6 months later, actually a little bit more than that. But like I said, this is the first of many, and this is typically something that grows over time. And so these are monthly returns versus where you're typically used to with syndications. Most of them are quarterly distributions. So if we go ahead and look at, let's just look here at 188.85. If we were to do that on an annual basis times 12, that'd be 22,2266 divided by my initial investment of 75,000 times 100. So we're looking at a 3% return here if we were to annualize this initial distribution. But again, guys, we are targeting a 7%. And as we talked about before, these are slightly under the initial projection. So I'm not concerned at all. I don't even really plan to look at this until likely a year or two from now, just kind of checking in to see how things are going and to stay in the loop, because again, I want to know kind of what this communication model looks like for being on an investment like this. So also on this portal, you do get all your documents here. They make things super easy, all your tax returns, etc. And again, a big reason why you want to invest in something like this, there was heavy depreciation. Like you guys saw, I did just invest in November and got almost 5K of write-offs in my K1 because of the way they accelerate depreciation. And again, that was only 1 month's worth. So I am looking forward to seeing what they come up with a full year of accelerated depreciation for this asset. So one last thing I just want to leave you guys with, when you start to invest and you start to acquire multiple properties, I found that you want to look beyond more than just the number when it comes to return. More than just what the financial return is, you almost have to start factoring in what is the time and headache factor that I'm gaining on an investment like this, rather than buying a duplex, trying to remodel it, manage it myself, etc. So for this one, I literally wired the money in. I don't think about it. I haven't lifted a finger. The most I've done is read a couple emails, which I didn't even have to do, and then that money just magically showed up in my account. So I think this is a great way to diversify. Once you start to get to a point where you have excess capital and you want to start to explore with different revenue streams that you don't have to be actively managing. But there is a downside. I could take this 75 grand and likely get a much better return if I were to buy a property myself, manage it myself, do all the work myself. But again, my time, I don't want to continue to do that, and it doesn't scale for the way that I do that. So this is a way for me to diversify, and hopefully it helps to kind of think through that. At some point, you're going to likely not want to be the sole person who's running all the daily operations in your business, but maybe you are, and maybe that's not for you. But just to kind of share my perspective, wanted to walk through that concept. And just to get ahead of any negative comments, calling me a moon boy or just, oversold on the way they're running this, as you guys can tell, I am super fanboy of, Brandon and Open Door Capital, just based on everything they've done so far, what they've done in my Fund 1 investment, investment to kind of give me the opportunity to put it towards here. This is kind of an experiment for me. So I plan to just anything they give me here, I'm going to roll it into their next investment. And hopefully, you know, in 10, 15, 20 years from now, I have the story of turning, what do you call it? I think I put 50 grand into start into, I don't know, hopefully it's $1 million by then. Let's go ahead and call it. Brandon, make my initial 50 grand turn into $1 million in 20 years. So, but with that, guys, we'll go ahead and wrap. I hope you got something from this. If you have questions or you guys want to see more things like this, tell me in the comments below, and I'm happy to keep you guys in the loop on how this particular investment is doing. But with that, guys, we'll go ahead and wrap. I'm Tyler Wayrung, and we'll catch you next time.